Today we will be talking about monetary policy. Monetary means of or relating to money. So monetary policy must mean how the Federal Reserve or the Fed, which we'll learn about in just a second, how the Fed changes the money supply in order to stabilize the economy. Here we go. If monetary policy is pretty new to you, then you probably don't know what the Federal Reserve is or what it does. So basically the Federal Reserve or the Fed utilizes the money that's in circulation, also known as the money supply. The Federal Reserve utilizes the money supply in order to stabilize the economy. So this is the big Federal Reserve. The Fed also controls lots of smaller banks, but their main job is to utilize the money supply to stabilize the economy. Just a little pointer, it's unhealthy to have rapid growth and then rapid decline in our economy. We want a nice steady growth that we can manage, just like that. There are many ways that the Federal Reserve can change the money supply, which is basically monetary policy, but I'm only going to focus on two with you right now. So first, the Fed can change the discount rate. The Federal Reserve loans out lots of money to the small and private banks that it's affiliated with, and in return, those banks have to pay an interest rate on those loans, and that interest rate is also known as the discount rate. So for instance, if the Federal Reserve wanted to take money out of the economy because demand was too excessive and the economy was growing too rapidly, then the Fed would increase the interest rate or the discount rate, because in turn banks would have to pay more money back on their loans because the discount rate is higher, which means that they have less money to loan out, which means that our interest rates on our loans are higher, which, you guessed it, halts demand. Secondly, the Fed could buy or sell bonds or government securities. Let me just say that when the Fed tells one of the small banks to do something, like one of the small banks that it's affiliated with to do something, those banks have to comply. So if the Federal Reserve, for instance, wants to put money into the economy because the economy is doing poorly and it's declining and demand is too low, then it would buy government securities from its smaller private banks. Let's pretend these blue things right here are government securities. So the Federal Reserve would buy government securities, and in turn, they would pay for them with money, and this money now can be loaned out by banks to you and me. So the banks have more money to loan out, which means that our interest rates could be lower, which, you guessed it again, increases demand. Let's say that American business is booming along, but a bit too much and a bit too rapidly. Everybody's going gaga over their fancy new phones. I know this phone doesn't look fancy, but just pretend. And everybody's going crazy for their nice new cars that just came out last week. And basically, the Federal Reserve notices that our economy is growing a little bit too fast and it's a little bit uncontrolled and demand is a little bit crazy. So they decide that they need to take money out of the economy, decrease the money supply in order to stabilize the economy. Remember, steady growth. So what they're going to do is, first of all, they're going to increase the discount rate, which will mean that banks have to pay more money on their loans back to the Federal Reserve, which will again mean that they have less money to loan out to us, which means that our interest rates will be higher, and again, demand will be lower. Secondly, the Federal Reserve can sell their bonds. They can sell their bonds back to the banks, which means that the banks will be forced to pay for their bonds with their own money, which will mean that the banks have less money to loan out to us, which will mean that our interest rates will once again be higher and demand will be lower. That is monetary policy. I hope this video helped you understand monetary policy, and I will see you next time on Past That Class. Thanks for listening.